Welcome to The Hindu editorial. My name is Ryan Pinto, and today's editorial is on November 24th and 25th. The topic of discussion today will be on the banking sector, which is going to be part of your GS paper 3 economics. And you must remember, particularly focusing on the banking sector. We know the Reserve Bank of India is a very important organization which controls the finance in the market. The Reserve Bank of India has its monetary policy through which a lot of objectives are achieved. You can say we achieve the objectives of inflation, growth, exchange rate, etc., employment, etc. So why are we discussing about the monetary policy? What are we going to discuss? A very important, you can say, committee which was set up by the Reserve Bank of India, which was an internal committee. It has given its report. So the whole point of discussion today is on that report. A very important committee on PK Mohanty committee, which we are going to discuss it in the later part of the discussion. During the end of the editorial, we are going to discuss about the PK Mohanty committee report. So please focus on that. That is very important. We can expect a lot of questions this year and in the coming year. And also the discussion on, can the corporates be given the license to start a bank or establish a bank? That's a major point of discussion that we are going to have today. Say no to the corporate houses in Indian banking. That is what the article is about, and the editorial focuses on why we should not be giving the corporate houses the Indian banking system. So very important editorial, you need to focus a lot. The banking sector needs reform, but recommendation of corporate owned banks is neither big bang nor risk free. So the author is trying to say that banking sector does need reform, does not mean that you give it to the corporate houses or private players. An internal working group of Reserve Bank of India, as I have told you, headed by PK Mohanty, has recommended that corporate houses be given bank licenses. The reaction has ranged from cautious welcome to scathing criticism. Many analysts doubt the proposal will fly. It is worth examining why. So we are going to see why the proposal is not good. In February 2013, the RBI had issued guidelines that permitted corporate and industrial houses to apply for banking licenses. Before 2013, remember, the RBI had said no private sector corporate houses should be entering into the banking field. We'll see the reasons why. But post 2013, they said it was allowed. But again in 2014, they stopped giving licenses to the private sector. Private sector was not allowed. So just remember, before 2013, from 2013 to 2014, and then post 2014. And in 2020 again, there is a recommendation which is given that let's allow the corporate houses to have their banks, which is dangerous. That is what the editorial is trying to say. So just remember, before 2013, 2013 to 14, 2014 post, and now 2020. So the RBI had issued guidelines permitted corporate houses and industrial houses to apply for banking licenses in February 2013. Some houses applied, although a few withdrew their application subsequently. No corporate was ultimately given a bank license. Only two entitled entities qualified for a license, IDFC and Bandhan Financial Services. So in 2013, many applied, but they did not fall into the RBI's criteria and they were not given. Two were given, IDFC and Bandhan Financial Services. Both were NBFCs, non-banking financial corporations. None of the applicants had met fit and proper criteria. In 2014, the RBI restored the long-standing prohibition on the entry of the corporate houses into the banking. The RBI governor was Raghuram Rajan. Mr. Rajan had headed the Committee on Financial Sector Reforms. So, under his guidance, he had said not to give this to the private sector or the corporate sector. So, let's see then what happened. So, we are going to see what are the repercussions. We are going to see what are the problems when the corporate houses hold the banks. Is it okay to give? Let's see the risks. The prohibition on the banking and the commerce combined still exist in United States. Many countries like United States don't allow the corporate houses to hold banks, and is certainly necessary in India till private governance and regulatory capacity improves. In India also we have to complete it because or continue it because private governance is not that great, regulation is not that great. RBI's position on subject has remained unchanged since 2014. Since 2014, we are not allowing corporate houses to hold banks. Corporate houses will bring capital. Many people will think, what is the benefit? They will bring capital and expertise to banking. So you have new public management, you have good officers and etc., managers, etc. Moreover, not many jurisdictions worldwide bar corporate houses from banking. Apart from USA and many other countries, there are corporate houses which are holding the banks. It is the downside risks that are worrying in the extreme. As the report notes, so see what is the main problem of the report. The report says interconnected lending, concentration of economic power, and exposure of safety net provided to banks through guarantee of deposits to commercial sectors of the economy. These three are the most important point of concern. Interconnected lending means one, you have two, you can say companies of the same parent company. There are two subsidiary companies, and subsidiary companies can give money to each other. Say for example, X company has a bank, X company has also a automobile industry. So bank can give, same company can give automobile industry, though it might be under losses. So that is interconnected lending. Concentration of economic power, exposure of the safety net provided to banks to commercial sectors of the economy. We are going to discuss in detail. So three points, remember. Corporate houses can easily turn banks into a source of funds for their own house or their own businesses. In addition, they can ensure that funds are directed to their cronies. They can use banks to provide finance to customers and suppliers of their businesses. Adding a bank to a corporate house means an increase in concentration of economic power. So they can use it for their own. So now when you have a bank, the money is all of the public. The money belongs to the public. They are the owners. You can't have the bank just using public money left, right and center without being responsible or accountable. If corporate houses are given this power, it will happen. Not least, banks owned by corporate houses will be exposed to the risk of non-bank entities of the groups. So now, as I gave you the example of X company, which is having a bank, giving money to the X company's automobile industry, and that is going into losses. Say for example, it is going into losses. Because of this X company's automobile industry going for losses, the banks will also not be able to sustain. People will run to the bank and take out their money, and the bank will also collapse. So it will be exposed to the risk of non-bank entities of the group. If the non-bank entities get into trouble, sentiment about the bank owned by the corporate houses is bound to be impacted. Depositors may have to be rescued through the use of public safety net. Then who has to come to save that bank? It's the RBI, again using the public money. The internal working group believes that before corporate houses are allowed to enter the banking, RBI must be equipped with a legal framework to deal with interconnected lending and a mechanism to effectively supervise conglomerates that venture into banking. So interconnected lending is having these issues, which leads to crony capitalism, which leads to bank being exposed to non-bank entities, etc. Next issue is tracing interconnected lending. It will be a big challenge. Monitoring of transactions of corporate houses will require the cooperation of various law enforcement agencies. Corporate houses can use their political clout to thwart such cooperation. So tracing of this interconnected lending is very, very difficult. Sometimes it is not so obvious that one company is a sister company or a subsidiary company of the other. Becomes little difficult. So that is why it will need the monitoring of various law enforcement agencies. So this is the first issue on interconnected lending. Second, the RBI can only react to interconnected lending ex post. That is, after the lending is being done, then the RBI can come into picture. That is, after substantial exposure to the entities of the corporate houses has happened, it is unlikely to be able to prevent such exposure. Can't do anything before. Third, suppose the RBI does latch to an interconnected lending. How is the RBI to react? Because if any action is taken by the RBI, in case of interconnected lending, if any action is taken, could cause a flight of deposit from the bank concerned and precipitate its failure. So A bank is giving to A's automobile industry, and then automobile industry is closing down or is in losses. RBI takes some decision. People will take out the money, and even A bank will be affected. So that is a concern. What can RBI do in this case? Fourth, pitting the regulator against powerful corporate houses could end up damaging the regulator. People will lose confidence in RBI also because of all these things. The regulator would be under enormous pressure to compromise on regulation. Its credibility would be dented. There are corporate houses that are already present in the NBFCs, that is non-banking financial companies, and they are allowed, if they are working for 10 years, they are allowed to the NBFCs are allowed to have bank licenses. So such ways are also there. Under the present policy, NBFCs with a successful record of 10 years are allowed to convert themselves into banks. The internal working group believes that NBFCs owned by corporate houses should be eligible for such conversions. This promises to be an easier route for the entry of corporate houses into banks. So the editorial says this will allow many private houses will start NBFCs, wait for 10 years, then convert into banks. There is a world of difference between corporate houses owning NBFC and owning a bank. Bank ownership provides access to a public safety net, whereas NBFC ownership does not. NBFCs are different from the banks. Banks ownership will allow to open or you can say get access to public money, whereas NBFC does not. NBFCs can't loan to or can't take deposits and can't work like a normal bank. The reach and clout that the bank ownership provides are vastly superior. Main difference between NBFC and bank, you must remember, NBFCs cannot keep current account and savings account. That is one thing you must remember. They can't issue checks and all, which the banks can do, and that is why the banks have got a lot of money and deposits, which the NBFCs don't. So these people will take advantages of all these situations. The objections that apply to a corporate house with no presence in a bank-like activities are equally applicable to corporate houses that own NBFCs. What is the statement trying to mean? That you should consider the NBFCs without the bank, which is not allowed at the moment. They can't start a bank. They should be considered as the same as corporate houses with the NBFCs. Both are dangerous. Both can create issues in the banking system. It points to privatization. There is another aspect. So we have seen the issues. So we have seen interconnected or interconnected banking or lending. We saw the monopoly of the corporate houses increasing, the economic resources concentrating, and even we saw the NBFCs can start. And what are the issues? Issue of privatization, we'll see. There is another aspect to the proposal that cannot be ignored. Corporate houses are unlikely to be enthused merely by the idea of growing a bank on their own. So we saw from the issue, if the corporate house, why should the corporate houses not be allowed? There is another angle that corporate houses, they themselves don't want a bank to start the whole thing. They would be happy to take the already present banks. The real attraction will be possibility of acquiring public sector banks whose valuation has been battered in recent years. Public sector banks need capital that the government is unable to provide. The entry of corporate houses, if it happens, is thus likely to prelude to privatization. Given what we know of governance in Indian corporate world, any sale of public sector bank to corporate houses would raise serious concerns about financial stability. So the issue is the corporates exactly do not want to start a bank, but they would be very happy to take an already working bank, especially the public sector bank. India's banking sector needs reform, but corporate houses owning banks hardly qualifies as one. If the record of over leveraging in the corporate world in recent years is anything to go by, over leveraging means what? They are the banks, the private banks. You must have noticed the example is the Yes Bank and so many other banks. They have given loans left, right, and center by the management having some nexus with the person or the debtor, and the management is getting some commission in return. It is the public money, so the management just takes out the money and gives it, keeping all the rules aside, and then it leads to NPAs and the banks to fall. And another issue is they are ready to take a lot of risk, that is the private sector banks. So it's a dangerous situation. Industrial houses should not have access to household savings through their own banks. So they should not have access. That is what the second editorial trying to say. Strong reactions to an internal panel's report on November 20, almost a full month since the group of central bank officials had submitted their recommendation on October 26, came as no surprise. So there was a strong reaction on this panel's recommendation. The panel, which was tasked with the reviewing of ownership norms and corporate structure for private sector banks, has made worthwhile suggestions, including ways to harmonize licensing norms. So the panel has given other recommendations also, but this was severely criticized for all banks, including older legacy lenders and newer entrants. Its suggestion that corporate or industrial houses be allowed to promote banks has triggered widespread concern. So there are many suggestions given. The most critical was this one: corporate houses to be allowed to start their own bank. And among those with reservations are at least 3 former senior central bankers and a global credit rating agency. So many have criticized. Some of the criticism is by Raghuram Rajan and Viral Acharya and global credit rating agencies. The difficulty in ring fencing, so the whole point again and again is interconnected lending. That's the biggest issue, because the corporate houses have got so many businesses, they can take the money and give it to their own sister companies, which is a biggest issue. The non-financial activities of the promoters with that of the bank was flagged by these experts as central concern, a fear that was echoed by Standards and Poor's global rating too. Okay, so non-financial activities, as I gave you, a company A which has a bank with giving money to company sister company with the automobile agency or industry. Former RBI Governor Raghuram Rajan and former Deputy Governor Viral Acharya who was appointed by the Modi government after Mr. Rajan had left central bank, in a joint article on LinkedIn, have termed the proposal a bad idea. Acknowledging the RBI group's caveats, including its assertion that corporates only be allowed as promoters after necessary amendment to the Banking Regulation Act. They should be only allowed as promoters, not be allowed to start the whole bank, are enacted to safeguard against connected in lending. So interconnected lending is the biggest issue. The two economists have, however, pointed to the bailouts of Yes Bank and Lakshmi Vilas Bank recently as examples of their risk posed by any move to loosen banking licensing norms. The dangers posed to overall financial stability by letting industrial houses have access to relatively inexpensive capital in the form of household savings through banks, howsoever legally regulated, are too far great to risk at the altar of liberalization. So just remember the dangers of overall financial stability by giving industrial houses to open their own banks is too dangerous for the liberalization norms. So these were the criticism. This was the article. Let's see what were the recommendation given by the PK Mohanty group that was set up to review the corporate structure by the RBI. So it was an internal committee which was set up under the retired IS officer PK Mohanty. So it's on your screen. Entry. So first, they have spoken about entry of corporates into banking space. Large corporates and industrial houses may be allowed as promoters of banks only after necessary amendments to the Banking Regulation Act. So that was the first recommendation they gave. So large corporate and industrial houses can become the promoters. A promoter is an individual or organization that helps raise money for some types of investment activity. This is to prevent connected lending and exposures between the banks and other financial and non-financial group entities. So this was the recommendation, first one, that let them be only the promoters. This is what is okay with Raghuram Rajan and Viral Acharya. They can't be allowed to set up a whole bank, just to become a promoter for some time. This is to prevent connected lending. So we had seen connected lending is a model as situation in which banks controlling owner extends loans of inferior quality at lower interest to himself or his connected party. So I hope you all have understood the meaning of connected lending, which means he is giving to his own company or connected parties. Credit exposure is a measurement of the maximum potential loss to a lender if the borrower defaults. So credit exposure is if a person is there who's going to default, so the bank is having higher credit exposure. So if you just remember, the RBI has been against allowing corporate houses to set up or run commercial banks due to their poor record on governance and credit disbursement. Corporate houses routinely delay payments to banks, and system has no inbuilt incentives or disincentivizes for orderly debt behavior. Mostly corporate houses are known for not paying, so they can't be allowed to start a bank. Conversion of NBFCs into banks. Second, you can say recommendation. Well-run NBFCs with an asset of rupees 5,000 crore and above, including those which are owned by a corporate house, may be considered for conversion into banks subject to completion of 10 years. So they have said not 5,000, it is 50,000 crore, sorry. So whichever NBFC which is having a asset size of 50,000 crores and have been working for 10 years with due diligence and compliance, they can start. Next is the hike in promoter stake. So the cap on the promoter stake for in the long run 15 years may be raised from 15% to 26%. On non-promoter shareholding, the panel has suggested uniform cap of 15% of the paid up voting equity share capital of the bank for all types of shareholders. So just remember, first we spoke about the interconnected lending. Second is conversion of NBFCs, hike in promoter stake, hike in minimum capital for the new banks. The minimum capital requirement for the licensing new banks should be enhanced from 500 crores to 1000 crores for universal bank, 200 crores to 300 crores for small finance banks. Just remember, they can ask these things in your question papers, that what were the recommendations given. So just remember, interconnected lending, conversion of NBFCs to banks, 50,000 crores, promoters stake from 15% to 26%, minimum capital from 500 crores to 10,000 crores, 200 crores to 300 crores for small finance banking. Universal banks means the normal banks that we have, which does wholesale banking, retail banking, investment, etc., like Deutsche Bank, Bank of America, etc. Payment banks conversion into small finance bank. Payment banks intending to convert to a small finance bank, a track record of 3 years of experience as payment bank may be considered. So payment banks are banks like Airtel Payment Bank, India Post, etc. They are all payment banks, and they are only used for uh, uh, bills and small, you can say, small things. Okay. Small finance banks are financial institutions which provide financial services to unserved and unbanked regions. So, small finance bank does is like a normal bank, but its size is smaller. Whereas payment banks only for the bills and all those things, very restricted. So that is again another recommendation. Harmonization and uniformity in different licensing guidelines. So the RBI should take steps to ensure harmonization and uniformity in guiding different licensing guidelines. Whenever new licensing guidelines are issued, if new rules are more relaxed, the benefits should be given to existing banks. And if new rules are tougher, legacy banks should also conform to the new tighter regulation. But a non disruptive transition path may be provided. So, harmonize and uniformity in the guidelines, licensing guidelines, is the next point. Non operative financial holding company. So just remember, what are the recommendations that we just saw. So the recommendations that we just saw was, first was the interconnected lending. Second is conversion of NBFCs into banks. Third is hike in promoters stake 15% to 26%. Hike in minimum capital 500 to 1000 crores, 200 to 300 crores. Payment banks to be converted into small finance. Make the guidelines uniform. Finally, non-operative financial holding company. Non-operative financial holding company should continue to be a preferred structure for all new licenses. However, it should be mandatory only in cases where individual promoters, promoting entities, and converting entities have other group entities. So, non-operating financial holding companies should be given more preference while giving licenses. Way forward. The recent failures of internal and external controls in banks like PNB to an alarming fraud, like we had the fraud which was done by Nirav Modi, etc. Failures of banks and NBFCs like Lakshmi Vilas Bank, Yes Bank, where all stakeholders lost money and credibility, have given rise to need for a new regulation with a very high degree of supervisory mechanism and corporate governance, which has strong information technology and artificial intelligence enabled platforms. So we need a lot of reforms, regulations, so that banks can do better. Where a corporate house is a promoter, strict regulations on the use of funds held with the bank and monitoring of related party transactions will be essential. Fit and proper criterion needs to be foolproof, and common citizens should become the beneficiaries. So just remember, with the recent, you can say, experiences with PNB and IDBI and Lakshmi Vilas Bank, Yes Bank, proper reforms needed, regulation needed, and all this for the benefit of the people, not of the corporates and the banks. So this is the complete issue. Please write down the issue and use it in your answers as well as your essays and the other things. Remember, the art and science of asking questions is the source of all knowledge. Thank you.